Index funds are like baskets of stocks. They aim to track the performance of a specific market index. Think of it like a pre-selected stock portfolio. This portfolio is designed to mirror a particular market segment. One common example is the S&P 500 index. Index funds offer a simple way to invest in the stock market. They provide broad market exposure. This makes them suitable for both beginners and experienced investors. Instead of picking individual stocks, you invest in the entire index. This is done through an index fund. Imagine trying to buy every stock in the S&P 500 individually. It would be time-consuming and expensive. Index funds simplify this process. They bundle those stocks into a single investment. This makes it easier to achieve diversification. Diversification is like not putting all your eggs in one basket. It helps reduce risk in your investment portfolio. Let's delve into a specific example, the UTI Nifty Index Fund. This fund tracks the Nifty 50 Index. This index comprises 50 of the largest and most actively traded Indian companies. The UTI Nifty Index Fund aims to replicate this index. How does it achieve this? The fund manager buys the same 50 stocks. These stocks are bought in the same proportions as they are in the Nifty 50 Index. This mirroring strategy ensures the fund's performance closely aligns with the index itself. For instance, if Reliance Industries constitutes 10% of the Nifty 50, the UTI Nifty Index Fund will also hold 10% of its assets in Reliance Industries. This replication strategy is at the core of how index funds operate. It ensures that when you invest in the UTI Nifty Index Fund, you are essentially investing in the performance of the Nifty 50 Index. This direct correlation simplifies investment tracking and provides transparency. The returns from index funds are typically similar to the index they track. This is because the fund holds the same stocks in the same proportions. If the Nifty 50 index goes up by 5%, the UTI Nifty Index Fund is also likely to go up by a similar percentage, minus fees. It's important to note that there might be minor deviations. This is due to factors like expense ratios and tracking errors. However, these differences are usually minimal. Over the long term, index funds have historically provided returns in line with the market. This makes them a reliable investment option for those seeking to participate in market growth. Remember, past performance is not indicative of future returns. However, the historical correlation between index funds and their respective indices instills confidence in this investment approach. This predictability is a key advantage of index funds, especially for long-term investors. The UTI Nifty Index Fund, as we've discussed, mirrors the Nifty 50 Index. This means its composition reflects the top 50 companies listed on the National Stock Exchange of India. These companies are leaders in their respective sectors. This includes sectors like finance, technology, energy, and consumer goods. Investing in the UTI Nifty Index Fund provides exposure to a diverse range of companies. This diversification helps mitigate risk. When one sector might be underperforming, another might be flourishing. This balance within the index helps cushion the impact of market volatility. The specific composition of the fund will change over time. This depends on the performance and weightage of companies within the Nifty 50 index. However, the underlying principle remains the same: to provide investors with a diversified exposure to the Indian stock market through a single investment vehicle.